Welcome to the InterMarket Analysis video update. This is a weekly video that is prepared to look at markets outside of the S&P 500 to do some comparisons and see how things are acting in different markets, and with the idea that maybe that'll give us some insight into the stock market in general and the S&P 500 in particular. This is being recorded Sunday, October 30th, and this will apply to Monday, October 31st. So happy Halloween. The first thing that we look at is how's the valuation looking on a historical basis. We have the red line at the top, which is a PE ratio of 20. When stocks are 20 or above, they're considered to be expensive. When they're at the blue line, which is a PE of 15, they're considered to be fairly valued. And when they get down to the green line, a PE of 10, that's considered to be inexpensive or cheap. Well, when you see the S&P 500, we're just slightly above the dashed red line. It's a little bit hard to see, but the red line has been coming down as earnings have been lowered in 2022. Down below, we see the difference between the S&P and the red line, and we're just slightly above that. So on a historical basis, the S&P 500 now is considered to be just a little bit expensive. Now, the market uses a thing called forward PE ratios, and they tend to be more liberal and more full of hope. And now we're currently right at about the fair value level, between 15 and 20. I don't have an actual chart to show you that, but I do look at that value every day just to see what is the market using to go forward. But we can get some good insight by looking at this chart, going all the way back to 1980 and different events that have happened and what was the market valued at the time. We can also see that the market can remain overvalued for a long time, years, before it ends up coming back into a more equilibrium. And so people that invest like this, when it becomes overvalued, that doesn't necessarily mean sell everything right now. That just means be aware of what's happening, and we might be heading for trouble at some point, and then you may want to consider getting out of some stocks. You can also do this same measurement on a stock-by-stock basis, on a sector basis, on an industry group basis. I do this on an S&P 500 basis. I do every day in the daily video update a thing called the possible positive scenarios. We look at some different things when the market's going up, when they're turning more positive, that can lend some support to the S&P 500 going higher. I don't include those in this video, but please watch the daily video updates for any of those updates. The first thing we look at is growth, and this is what really makes stock prices go up. When growth is doing good, that's when the S&P, the Dow, the NASDAQ 100, that's when they're moving higher. Well, we've been in an overall downtrend. We're below this red line, which is the 200-day moving average. And even though we are showing some improvement, we've been able to get back to the 50-period moving average. We're still in an overall downtrend. We also look at just a value index where it's actually showing a little bit more improvement, but it is also in an overall downtrend. Now we look at a ratio between the two. That's the top chart that shows how growth has been underperforming value. The bottom chart shows how value has been outperforming growth. Then we look at it, some other indexes, and compare them to see where growth has been underperforming and is still in an overall downtrend. Here's an inverse of that same chart showing how value has been performing better than growth. And then we look at some ETFs, and we're seeing kind of the same thing. I like to look at a lot of different indexes and ETFs because sometimes they tell us a little bit different story, but here it just shows where growth continues to be in an overall downtrend. Here's an inverse of that same chart showing how value has been outperforming growth. And then the last chart just shows, again, on an index basis, how growth has been underperforming value. Some other markets, these are the 30 biggest software companies, and they're in an overall downtrend. Even though they're trying to show some improvement right now, they're back up to their 50-day moving average. Here's a monthly chart of the CRB index, which is what we use to measure inflation with commodity prices. And even though we're still in an overall uptrend, we are starting to show some weakness. If you look down at the bottom, when we're above this red line, that means it's more inflationary. When commodities are going down, that means it's more deflationary, and that's what we're showing currently. Then we have the Baltic Dry Index. What does it cost to ship products from point A to point B? When this is going up, that means the cost is increasing. When it's going down, it's decreasing. And after bouncing back up, it's still in an overall downtrend. Then here's the CRB index itself with a daily chart showing that we've now crossed, and we have a death cross here. So we are now in a downtrend as far as the CRB index is concerned. Looking at corn, after spiking up and coming back down, we're kind of more in the midpoint. Here's aluminum. After spiking up and coming down, we're still near the lower end of its decline. Heating oil is kind of spiked up and stayed right around these current levels, and this will come into play more as the weather turns colder. Gas, which had really spiked up, and then you have the current administration doing everything possible to bring gas prices down by using the strategic oil reserve. Well, that did bring prices down, but now they're starting to go back up. Then natural gas, which after spiking up to about 10, has really started to fall. Oil, which had really spiked up to 130, is now down around the 87.90 area. I'm also showing diesel. I'm hearing more about that in the news, that there could be some real diesel shortages at some point, and our economy really relies on that. And even though prices are high, it's not really showing it spiking up an awful lot currently. Here's wheat. After spiking up and coming back down, it's starting to show some declines. Fertilizer, another thing that feeds into the whole inflation scenario. Even though fertilizer prices are very high, they have been coming down recently. Here's lumber, which has been in an overall downtrend. It was trying to bounce back up, but now is continuing with the downtrend. The dollar, and a lot of people are really blaming the falling commodity prices on the rise of the dollar. And it's still in an overall uptrend, but it has been showing some recent weakness. And then we compare that to the euro, where the euro's been bouncing back up recently, but is still in a downtrend compared to the dollar index, which is in an overall uptrend. Then we also look at the Japanese yen, which has been declining overall, as has the euro, which we just showed, and then the dollar index, which has been showing strength. And then the British pound. They were having a lot of political issues in the UK. It seems as though things have stabilized a little bit. They still have a lot of problems there, but their prime minister, who had been in office for 6 weeks, resigned. They now have a new prime minister, and that seems to be stabilizing the currency, even though it's still much lower than it had been in the recent past. Copper, which is a barometer of the economy, after really declining, has pretty much been going sideways. And then we look at a copper to gold ratio, which just shows that copper has been outperforming, even though it has some weakness here. It's still in an uptrend when compared to gold. And here's a longer term look at that chart where we compare it to the 2-year treasury yield. And oftentimes they tend to move in the same direction, and they tend to not get really far apart, even though they're on different scales. They're really far apart, and they're kind of going in opposite directions currently. Gold continues to be in an overall downtrend, as does silver. Looking at some indexes, we have the CRB, which is still outperforming the S&P 500, but that could change pretty soon. And then here's an inverse showing how the S&P 500 has been underperforming the CRB index. Here's the NASDAQ 100, which is growth compared to the S&P 500 and how it's been underperforming. And here's the mega cap growth stocks. These are the real big ones, the Microsofts, the Apple, the Googles. They're in an overall downtrend currently, and they're trying to make a run back to their 50-period moving average. Here's the S&P 100 against the rest of the S&P 500, and it continues to underperform. Here's small caps, which this could give some hope to the stock market because they're outperforming the S&P 500 right now, and sometimes that can help the S&P 500. Low volatility stocks, which are in an overall downtrend but trying to recover. This is what folks get into when the market starts having some difficulties. And then we do a ratio just showing how the low volatility stocks have really outperformed the S&P 500. And it doesn't mean that the low volatility stocks are going up. It just means they might be going down less than the S&P 500. The Dow Jones Composite Average, this takes the Dow, the transports, and the utilities together. And even though it's in an overall uptrend, it has been showing some recent strength. Then we have Dow Theory. Here's how the Dow has been showing, and it's looking the best on a technical analysis basis out of all our different indexes between the Dow, the S&P 500, the NASDAQ 100, and small caps and mid caps, where we're seeing a little bit of a negative divergence because the Dow is really starting to go back up. The transports, although they're going up, are not going up quite as quick. And the utilities really took a big dive there, but they're starting to show some improvement. The FANG stocks, this is the Facebook, the Amazon, the Apple, Netflix, Google, really struggling right now. And there's some more stocks that are now included in this, and they're in an overall downtrend. And that's mainly due to some earnings reports that were not well received. ARK, it was up a little over 2.5% on Friday, but it still continues to be in an overall downtrend. Bonds, which have really been suffering, they just continue to be in a downtrend based on price, as is our world bond index. Even though it bounced up a little bit on Friday, we have really exceeded the COVID lows. There's a monthly chart showing how stocks have really been outperforming bonds. Here's another chart showing how bonds have been underperforming stocks. Here's the stock to bond correlation. They have a tendency to go in the same direction as the market was rebalancing earlier on. Now it's starting to come back up. As we get closer to a reading of 1, that means that they're going lockstep in the same direction. If we fall below this neutral area and get to -1, that means they're going in the exact opposite directions. This could help the market because if this reading gets higher, that means bond prices are going up. That means also that interest rates are going down, and that could give some support to stocks to go higher as well. The 10-year Treasury yield, after really spiking up, is now settled down just a little bit over 4%. And the corporate bond index, this is bonds, corporate bonds based on price, they're still in an overall downtrend. The 10-year yield, after really spiking up, is also fallen down, and it's just over 4% as well. The 30-year yield is also just a little bit, it's at 4.15%. Here's the S&P against the Treasury yield. This just shows how interest rates have been going up a lot faster than the S&P 500, so that's why this chart is declining. Junk bonds, which tend to follow the market, they're in an overall downtrend right now. And these are the ones that give higher yields. And because even though interest rates are going up, historically, interest rates are still very low. And folks want to get a better return. So sometimes they're willing to assume more risk. And so they get into lower rated bonds, which the lower rated ones are often called junk bonds. They can give you a higher return, but you're also taking on more risk. This also shows how junk bonds have really been outperforming Treasury bonds, which are considered, Treasury bonds are very safe, or junk bonds are considered to be risky. And here's a daily chart of the yields showing how the 2-year is still in the lead. That's giving you the best return. And these lines are starting to go back and forth and across each other. And we have inverted yield curves right now. That just means that we're not in a real healthy economic environment. Here's a weekly chart on an international basis showing how the UK had really spiked up and is now coming back down. The US is also coming back down slightly, and German rates, after spiking up, are also coming back down. And Japan, they're kind of in their own little economic crisis or potential powder bomb that could explode at some point in the future, but they're really trying to keep their interest rates more at neutral or at zero. Looking at some of the other indexes, this ratio could be really helping us. When the S&P to the utilities ratio is advancing, that means the S&P is outperforming, and a lot of times that will mark a low in the S&P. When we spike out and start to go down, that also can signal a high in the S&P 500. The staples have really been showing some improvement. They're back up to their 200-day moving average, but they're still in an overall downtrend. And then energy, which has been the place to be compared to the S&P, just shows how energy has really been outperforming, even after seeing some weakness. Tech, even though it's come back up to its 50-day moving average, is still in an overall downtrend. Semiconductors still have some work to do to start to look better. They're in a downtrend as well. Tech to the S&P has really been underperforming. Then some other areas, here's growth, which has been suffering against bond prices, which have been suffering. It shows that growth, even though it's not doing very well, it's doing better than bond prices. And here's the rise in interest rates are going up when you compare it to the tech sector. And here's the tech sector going down when compared to interest rates. Discretionary against staples, after trying to show some improvement, have now been underperforming. And staples have really been outperforming discretionary. Here's the energy sector, which is really outperforming the tech sector, which not too long ago, it was just the other way around. Here's gold, which continues to underperform the S&P. Gold also is underperforming the dollar. And high leverage loans, these are riskier loans. They're in an overall downtrend, but they have been trying to show some recent improvement. And here's our InterMarket Analysis chart showing how oil is still in the lead, followed by the dollar. Here's gold going back to the beginning of the year, stocks, and then bonds, which remain negative. Some other indexes, we look at the Amex, the NASDAQ, and the NYSE, and then look at a 5-period moving average of their highs minus their lows. Still negative, but we did give an extreme reading right here, and it is showing some improvement. This is one of our possible positive setups that we look at. Small caps, which are looking better. They regained the 50-period moving average, and now they could be making a run for the 200-day moving average. Mid caps, kind of the same thing, above their 50, making a run for the 200. And the Dow, this is what I said, when the Dow's looking the best, it's actually above its 200-day moving average. Still in a downtrend overall, but if it can stay above this 200-day moving average, eventually we will have a golden cross. The NASDAQ has a lot more work to do. It has some overhead resistance and has not been able to get back to the 50-period moving average, and the same thing with the NASDAQ 100. The Wilshire showing a little bit of improvement by getting above its 50-period moving average, but still in a downtrend. All stocks coming back up to its 50-day moving average. So you have to wonder, is this going to act as resistance here? Because we're still in an overall downtrend. Emerging markets still are having a lot of trouble and are in an overall downtrend. Internationally, China has been having some trouble. They're trying to turn back up slightly with the emerging markets, and Europe and Japan and in the US with the S&P 500. According to this indicator, things are starting to improve, but we're going to need to see follow through. And Bitcoin, it kind of broke all the way up to 20 after being in the 19 range for quite a while. It's pretty much been going sideways now since the beginning of summer. Some of our correlations, looking at the S&P 500 against the dollar, they're having a pretty strong tendency to go in opposite directions, where oil and the S&P are now starting to go more in the same direction. Here's the S&P to the 10-year, which the market did some rebalancing during the week. And that's why this really spiked up. Well, now it's starting to come back down, but it's giving us almost a neutral reading. And here's the tech sector to the 10-year yield, which is in neutral territory. And the S&P to the 2-year, having a slight tendency to go in opposite directions. So what's positive? If you've watched more than one of these videos, these things have not changed. The dollar's still in an uptrend, energy's still in an uptrend, and interest rates, even though they're taming a bit, are still in an uptrend. And then when you look at all of the negative areas, which is pretty much everything else currently. So thank you. I hope you found this useful. Please feel free to check out any of the full-length or daily brief videos that I post. There's also a weekly video that you're free to watch. And have a great week, and I'll update this again next weekend.